Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. I've been doing financial analysis and financial work for corporations for 20 years. I'm happy to show you how to read a balance sheet. So behind me is the balance sheet from the most recent annual report, the 10K for Coca-Cola Company. And balance sheets should always start, at least in the US, with current assets. The very first current asset is always cash. Now, the asset statement begins with the most liquid and comes down to the most illiquid. That's the way assets are generally written. Current assets are assets that are due or liquid within a year. Long-term assets are long-term assets, right? So if you're ranking the balance sheet in terms of liquidity, you'll start with the most cash-like, which is cash and cash equivalents. What is a cash equivalent? A treasury security, an investment that's short-term in nature, that the market itself is so liquid, so guaranteed, it will treat it like cash, which would be a U.S. Treasury bond. Treasury note, something short-term, not a bond. Cash equivalents, that's the first. Next, underneath there is generally short-term investments. A short-term investment might be an investment for 6 months. That's less cash. It could be like a CD. It could be like an investment in another company or another investment that matures in a year. A bond they bought in, if this is Coca-Cola, maybe they bought a bond in Apple, let's say, and that bond matures in 6 months. It's not cash because it's an investment in something that's not guaranteed, such as a stock or a company that's a bond. But if it matures in less than a year, it's a current asset, so it's a short-term investment. Those two kind of represent the cash on hand for the business, if you will. And so you have total cash short-term equivalents. Now, interesting, Coca-Cola has a lot of cash on hand, so they do marketable securities. They actually own investments in other assets, other stocks. So it is one less notch down. It might be a long-term investment. It could be less than a year. No, it's current, so it's less than a year. But it's a marketable security, meaning it's a stock or some kind that they plan to sell within a year. But it's not exactly as cash-like as a treasury bond or cash itself. Marketable securities. Now, if I'm looking at excess cash when I do my channel, I will generally pull short-term investments, and if there's a marketable securities line, I will say marketable securities is also a cash-like item. One note on cash, you might see restricted cash on the balance sheet. Coca-Cola doesn't have any, but restricted cash is cash that's not cash. What does that mean? It means they took a loan from a bank or they have a contract with a vendor, an entity, and that vendor or the bank says, listen, take this cash, this dollar amount, and set it aside. It's mine. You can't use it. You can keep it, but you can't use it. And if you see restricted cash, you subtract that from their actual cash holdings, because it's cash that they're showing that they have, but they actually can't use it. So what's the point? Get rid of it. Next on the list, trade accounts receivable. An account receivable is merely a sale that you made which you haven't received cash for. So Coca-Cola sells a bunch of Coke, books the revenue as sales, but the vendor hasn't paid them yet. That's what this is. This is generally very liquid. They test it for allowances for default all the time, so they're always making sure that it's good and accurate. And generally those come in like a 60-day, 60-day time frame, maybe 15 days. Depends how big you are, how much influence you have. Inventory, obviously inventory. It's stated generally as, could be LIFO, FIFO, average cost. There's a whole bunch of different ways to state the value of inventory. That's an accounting section. I'll let you go discover that one. But the thing here is it's an asset, it's valuable. It's not exactly cash. So this dollar amount they have for inventory, which is here, $3.4 billion. If you were to liquidate this and need the business right away, you would not get $3.4 billion for this. You would have to sell it at a discount to move it more quickly. So whereas you can get this number, $9.6 billion, it's pure cash, you would get that in a liquidation sale. Same thing here with the short-term investments. Maybe the marketable securities, you would not get 100%, maybe you get 95% of the value. Well, trade receivables, maybe you get 90% of the value. Inventory, maybe you get 85% of the value. You get the point here. It's like if you had to liquidate the business because of bankruptcy, the amount of discounting you'd have to apply to get the cash today increases as you come down the asset schedule. Let's keep going. Prepaid expenses, that's an expense that they've bought. They already paid for it, but they haven't recognized the cost. What would this be? Let's say you bought your audit bill is coming up and you pay your auditors for your annual bill in advance. They haven't done the audit yet, but you gave them the cash to go start working on it. That's a prepaid expense. total current assets. Equity method of investment. Now, if you looked at the income statement video that I did, on the income statement, it represents the change in that value. This is the carrying value of the equity investment they have. So $17 billion, $17.5 billion. They're saying they have made investments in stock, common stock ownership in other companies that is worth $17.5 billion that they don't control, so they're not consolidating on their balance sheet as though they bought 100% of the business. They basically made a stock investment. That stock investment is worth $17.5 billion. And if this changes up or down annually, GAAP makes them expense that on their income statement, which means income statement can be much more volatile going up and down depending upon what this number does, and that's why you want to look at operating income, which is above the line on the income statement. It smooths out some of those changes. But I get distracted. Here we go. Other investments, kind of the same. Other investments. Other non-current assets. Another non-current asset might be some sort of intangible item that they bought, or a factory that they bought that they don't want to put into property, plant, and equipment. It could be some other maybe vendor that they paid a long-term contract with that they prepaid people greater than a year out. It could be anything. Deferred income tax asset. This is the bridge between the taxes they report on the income statement and the taxes they actually paid to the IRS. Again, all companies can have two separate books. They have books they show investors, and they have books they give the government. The government books have different depreciation schedules and of assets than the depreciation schedule that they show investors. And what that does is it creates a difference between the two separate sets of books. That difference is what's owed in taxes and expressed as a deferred tax asset or deferred tax liability, depending upon which way it goes. Property, plant, and equipment. This is their manufacturing infrastructure. These are hard assets, buildings, machinery, equipment that they use to manufacture products. It's the investment that they make over long periods of time, and they depreciate those over time on the income statement, 1/20th or so, however long the asset. A car might be worth 5 years, a building's worth 20. It depends on the asset. Every asset has a schedule. And the phenomenal team at Coca-Cola, I'm sure, has a massive Excel sheet, because everyone still uses Excel, that has every single asset they've ever bought, an associated schedule year of depreciation, and how much is depreciated over time. It's probably a monster sheet. And it's always stated net of depreciation. That's what this means. This means gross, what I actually paid for the asset, net of the depreciation that I've expensed over time, the accumulated depreciation. What does that mean? It means if I bought a building for $10 billion, I'm going to own it for 20 years. I'm 5 years in. The last 5 years, I've expensed 1/20th of that asset every year. 5 years in, I'm going to sum all that up, all the 5 years of depreciation, and I'm going to say my $20 billion building minus 5 years of accumulated depreciation, just adding up those 5 years, gives me the net value, the remaining 15 years of asset value. That's what this is saying. It's the remaining life, the remaining value of the business. Trademarks with indefinite lives, yeah, good luck with that. So that's basically intangible assets. It's when you buy a company, you might pay a premium over the asset value because the brand name. It's basically a GAAP allows you to take that and capitalize it as part of the purchase price. It's very nebulous. In a bankruptcy filing, not that these guys are going bankrupt, but in a bankruptcy filing, that stuff is generally written off. It's very hard sometimes to really monetize a brand name. Goodwill. Goodwill is the premium, the unexplained premium that you paid for an acquisition. So I'll give you an example. Let's say Coca-Cola bought Monster Beverage for $10 billion. They own 100% of it. They will take all of their income, all their assets, they'll consolidate them and report them on here along with the rest of the financials they have. But let's say that the business itself was only worth $7 billion in terms of the assets. $7 billion, they paid 10, so there's $3 billion of unknown value there. The asset value, $7 billion. $3 billion of unknown. We'll say $2 billion of the unknown is for the Monster brand name itself. So they would say, trademark, give me $2 billion there. for the value of Monster brand name itself. And then there's another $1 billion that's completely unexplained. The asset value was $7 billion, so the assets go property, plant, equipment, and scattered all through here. So that's $7 billion. I get another $2 billion that go to trademarks, because I'm kind of just bucketing. I'm saying, it's worth, thumb in the air, $2 billion. So here's $2 billion for trademark. And then the auditors say, well, it was worth $2 billion, but you paid 10, so there's another $1 billion that we can't really give you credit for. Where do we put it? Goodwill. The catch-all bucket for any acquisition you made. That sits there. It's non-depreciated. You can't depreciate it. You can in a private business, but you can't in public. Cannot in a public business. And it sits there. And in a bankruptcy, it generally just is written off. That there's really no hard asset value there. So you want to be careful when you're looking at businesses, particularly businesses that have very high goodwill and intangible relative to hard assets. Here you have $100 billion of hard assets. $20 billion plus that's $35 billion. Roughly 35% is intangible and goodwill. That means you have 65% of actual hard assets that you could liquidate on an increasing schedule if you needed to get your cash back as the equity holder. Okay, that's the asset statement. Let's take a look at liabilities. So liabilities is the second half of the balance sheet. Remember, assets always equal equity plus liabilities. We're going to look at liabilities. Liabilities, the same thing for assets. The more current that bill is due, the higher up on the liability schedule it becomes. So accounts payable and accrued expenses. An accrued expense example would be not paying your auditor, but expensing it on the P&L. So you know your bill is coming up due for your auditors annually, and you're like, well, I'm going to hit the P&L now for my expense, but I'm going to pay them in cash in the future. That's an accrued expense. Also payroll. You get paid every 2 weeks in payroll, but you're working during that time and you don't get paid every single day. That is an accrued expense. You have earned a paycheck, but you haven't been paid yet. That is an accrued expense. And I will tell you, bankruptcy courts are very, very strict for companies. They must absolutely pay their employees first. In a bankruptcy filing, this thing gets satisfied as fast as possible. If it can't, the executives can be legally held liable for requiring employees to work and not paying them if in a bankruptcy case. Accounts payable, that's just what you normally owe your vendors as well. So that's your ADP, your printing processing company, your vendors for the cans or the syrup vendors. That's all that stuff here. You order it, they give it to you. You owe them bills in 30 days. That owed bill sits here. Loans and notes payable, that's the current portion of long-term debt. So that's the principal payment and interest payment that's due within 12 months on the debt that you have outstanding. Current maturity, long-term debt. Oh, so then they just broke it out for you, two different lines. So that's exactly what it says. This is the long-term portion versus loans and notes payable or different caliber of loans, but they're the same bucket. It's debt that they have that's due within 12 months. Accrued income taxes, that's simply accrued income tax. It's taxes that they have expensed, they have not paid yet. That is the current liabilities. Again, current liabilities are liabilities that come due within 12 months. Current liabilities. Long-term liabilities. Long-term debt, obviously debt. Those are bonds. Those are notes or bonds that are issued, loans taken out that are due sometime out in the future. For Coca-Cola, let's take a look. $38 billion of long-term debt. Other non-current liabilities, that could be some sort of legal settlement that they owe over a period of time. That could be a warrant or a note or some sort of contract that they've signed on to build a giant building, a long-term construction contract. That could be there. Deferred income tax liability. This is the counterpart, $2.8 billion. This is the counterpart to what is owed to the IRS that they have not actually paid yet. So you would net the deferred income tax liability with the deferred tax asset to get the net of the two. That is the Coca-Cola total liabilities. They don't actually have a total liability section, which is very weird. Normally there's a total liability section. Coca-Cola does not do that. Shame on them. They should definitely do that. They skip right into Coca-Cola shareholder equities. So the equity section of Coca-Cola starts with common stock. This is the common stock that was originally issued when Coca-Cola was founded. 25 cents per par value. It's been adjusted for splits over time. They didn't issue it for 25 cents back then. It's been adjusted for splits. The number of shares that they issued outside, and that's going to stay constant. That's just a constant in the balance sheet. And some companies will tweak this over time. Some companies will keep it constant and then show all the breakouts someplace else. The next one is the capital surplus. That is capital that has been paid into the business over time, such as raising rounds of equity. Retained earnings. Retained earnings is your net income less dividend is there, and it's cumulative over time. So you take last year's net income minus the dividend, and you add it to this line item, retained earnings, kept earnings. And then next year you do the same thing, and this number grows over time, assuming net income is bigger than dividend and net income is positive. It's just an accumulation of that. Accumulated other comprehensive income. What is other comprehensive income? A comprehensive income is your pension liability changes, your foreign currency changes, and it's basically keeping track of that on an accumulated basis. That just means taking last year's and adding it to this year's for pension liabilities, for currency issues, if you want to state your currency in all dollars, but you sell globally. So you're taking in yen, you're taking in euro, you're converting it, but you're just splaying everything in dollars. And the currency changes cause the value to change in the net income, whether you use average currency conversion for the year versus the currency conversion at the point of sale when it happens. There's differences there. Those differences are trued up in a bucket, other comprehensive income. Treasury stock. Treasury stock is the amount of stock, the shares that they have currently outstanding. When they buy back stock and they tear up treasury, they're tearing up treasury stock. So that's how you look at the equity statement. I generally look at the net number because depending upon how people classify or break this stuff out, it can get kind of onerous. I look at the equity value, and the equity value is basically total assets minus total liabilities. Again, I don't put too much stock in the equity value itself because the assets are stated at cost. The liabilities are not necessarily the dollar amount needed to pay off the debt. So it's a little bit of a grain of salt on the equity piece. I generally look at cash flow and just make sure that they don't have too much debt. I think that's the main takeaway. I would look at make sure they have cash. Make sure inventory itself isn't building too high, and make sure that the debt itself is affordable from a cash perspective. But that's basically how you look at it at a balance sheet.